Okay, folks, I think we can kick off. Apologies for my voice. I'm a bit under the weather at the moment, but luckily we have a wonderful guest speaker for you this evening. Um, my industry colleague, Gohar Abasi, he joins us from from Avalon, and he'll be covering two separate topics with you guys tonight. The first will be pricing, and then the second half of the session will be valuations and appraisals, this time from the perspective of a lessor. So you might recall that last week we would have had Ishka come in and talk to us, and they covered valuations as well. But I think Gohar brings another unique perspective to the whole concept of valuations, specifically from the mindset of a lessor. So I think without further ado, Gohar, I might just pass it over to you. You've run this session before, so you know how it goes. You know the drill. Um, it is recorded, so there'll be quite a good few number of students that watch back the recording. But anyone that's on live, per usual, if there's any questions that pop up along the way, they'll appear on that chat box. But um, I think I'll just turn it over to you, and you might give a bit of background about yourself as well before you dive into the content.
Sure, absolutely. So, hello everyone on the line, and hello in the future for anyone that's going to listen back to the recording. So, thank you for the kind words, Rob. And I also am slightly under the weather, so maybe excuse the odd cough. Um, so, a little bit about myself. I think on one of the slides I'll be going on actually has a bit of an intro, but I am working in Avalon for pretty much coming on to 6 years now. And the last time I did this session, I was working in the transaction structuring team, and now I've taken on a bit more of an expanded role in a dedicated, it's called the technical projects team. So essentially marrying my previous experience and focusing specifically on a lot of the asset side of the house, which is quite relevant given the topic here on aircraft valuations. Um, I've also worked for a year in Avalon in the investor relations team, and prior to Avalon, I was working in finance in various roles in London, and then before that back in Dublin. Um, so that's kind of my background in a nutshell. I've done this lecture. This, if I recall, maybe my fourth time doing it. I've also I do guest lecturing at Queen's University on some aircraft financing, but also just finance in general topics. So, if people have, as I'm kind of stepping through the material, if people have questions, be it specifically on aircraft financing or if it's something a bit more general that's on the slides, please do ask. And I think Rob will agree with me that we have found these sessions to be a lot more productive and fruitful when people are asking questions and there's a little bit more of interaction. I know it's difficult sometimes to ask the question, but honestly, if you're thinking of a question, if it's something that's not making sense to you, there's quite a good chance that there's someone else either online now or else when they're listening to it in the future will have the same concern. So don't be shy, even if you just want to type it out, that's totally fine. In terms of the format, excuse me, in terms of the format, I'm going to focus on a particular set of slides first. We'll try and get through that. And then we have a second set of slides, which is a little bit more detailed. We'll try and break, maybe maybe an hour and a half into it. Rob, if that sounds good to you, you let me know time-wise. I mean, I'll be here if people want to kind of continue, if they have questions throughout the break, etc. So that won't be a problem. Does that sound okay with you, Rob?
It should be fine. Wherever you feel that it's sort of a natural stopping point. Um, Sometimes I give them a break just so they don't have to stay on for 2 hours.
Yeah, okay. No, I'll try and do the same. I'm just going to test. So I don't think I have control of this, Rob. I might need to change the slide so I can see the first slide there. Yeah, I think that's you changing it, but I don't seem to have access to be able to change that. Yes. Yeah, exactly. So let's just continue with that if that's okay.
You're on the iPad, right?
Okay, cool. So that first slide, anyway, I think we can move on. That's just my credentials, which I think everyone knows. So this next slide here, I want to maybe take a little bit of time and focus on this. So, I work for Avalon, so I've just used them as an example, but this is, I mean, every leasing company, almost every company, I suppose, will have the same, there's a slide that's applicable here. And what I wanted to do is just sort of set this and frame this for everyone, that the topic of the slide or the topic that I'm going to discuss here is like pricing and evaluation of aircraft lease transactions, right? So if you are a leasing company, what are you looking at from an economic point of view? So there's obviously the credit risk component of it. There's the customer risk. But if you're looking at it purely from an economic return perspective, what are the things that you are focusing on, and how do you evaluate a transaction with the view of deciding, should I do this transaction or should I keep my capital and use it for a different transaction? So that's the overall, I suppose, scope and objective of this first set of slides, to explain that. Excuse me. So this slide just gives this is all, by the way, this is public information. There's nothing confidential here. So Avalon started in 2010, and you can see there was 3 owners. These are private equity companies. And then in 2011, there was a investment by GIC, and then different milestones in the company. I stopped at 2019 because since then, COVID has hit, and if you're looking at evaluating transactions, you want to almost ignore COVID, because that is a black swan event. It doesn't necessarily, that's not the normal operating environment. So why I've put that, you don't necessarily need to remember those milestones, but why it's important, why I put that there, that the particular ownership structure of a leasing company, and actually any company in general, will dictate and will determine how you evaluate a transaction, because different ownership structures will have a different they'll have a different expectation of a return, and then B, they'll actually be, some will be more cash focused, some will be more kind of an accounting profit focus. Others will have a much longer term horizon in terms of how they're putting their money in and getting their money out. So those things really matter, and those things are what determine what each company. So if you look at any leasing company now, you will need to determine what is their ultimate ownership structure at the moment, and then how that ownership structure is influencing how that company evaluates their transactions, and therefore those transactions that they do would have to be measured on those particular on that particular criteria. So just to use Avalon as an example, when it was founded in 2010, the founding shareholders or owners were private equity companies, and private equity companies, they generally want to, essentially, they put in their money and they want to try and get as much of a return on that on a cash basis as quick as possible. So any transactions that were being done in 2010 when the company started, there was a much greater focus on metrics such as the IRR, which stands for the internal rate of return. I know you guys have already looked at that, but just as a quick refresher, the internal rate of return is a metric that looks at how quickly cash is generated from a particular investment. So how quickly the cash is generated, and essentially it incorporates the time value of money. So it takes into account the discounting impact of an investment. Then, as as time went on, as Avalon matured in its corporate life cycle, it listed on the New York Stock Exchange in 2015, and at that point, the the focus of the business changed somewhat because we were a publicly owned company. There was a much greater focus on ROE metrics, and ROE stands for return on equity. And this is, a quick way to one way to define it is it's a measure of how efficiently a business uses its equity to generate profit. So that's one way to look at it, and it's a levered metric. Levered means that any debt that the company has been incorporated into that ROE metric. And then as the company got bigger, as we moved into say 2017, 2018, we were privatized again in 2016, and then our ownership structure was essentially a private holding between Oryx and Bohai Leasing. But again, that changed how we evaluated transactions. And another big milestone for our company was in 2019 when we were rated investment grade by Standard & Poor's, Fitch Ratings, and Moody's. And again, I'm not saying any of this for you to remember specific to Avalon. It's more of a general thing of as these milestones happen in our corporate life cycle, the way we evaluate transactions change. So we started with an IRR-based metric, then we looked at ROE-based metrics, and then we look, and even now we look at more yield-based metrics. And yield-based metrics are essentially what is the measure of return relative to book value on the balance sheet of a company. And just to give you very simply, when a company like Avalon, when we buy an asset, so say I go to Boeing or Airbus and I pay them, say, $50 million for an aircraft, when I buy it, the price that I paid day one, that is what I book on my balance sheet, and therefore it becomes the book value. And then the return of that asset, so say, if you think of the inflows, it's your revenue that's coming in, minus any expenses such as depreciation, etc. Whatever's left over, that is a return. So that return as a percentage of its book value is essentially what that aircraft is yielding. Now this is an unlevered metric, so it doesn't take your interest and funding costs into account, but it's still an important metric. One other thing that I want to highlight is if you see the second line there, the secured debt to unsecured debt. So secured debt essentially means when a company like Avalon goes to, it's a very capitally intensive business, buying and selling aircraft, leasing aircraft. So we go to debt providers such as banks and other institutions. We borrow money from them to fund the purchase of our aircraft. And at the start of our corporate life cycle, a lot of the debt that we received was secured. It was secured with collateral, the collateral being the aircraft. So if I go to a bank and I say, lend me, say, $40 million for this aircraft, I'm going to put in $10 million of my own money, they will say, okay, you can have that, but I want security for my loan, and that security is generally the plane. It's simply like your mortgage on your house. The mortgage is a loan which is secured by the asset, which is your house. So the exact same thing. Now that brings with it, I suppose, complications and inflexibility if you want to be buying and selling aircraft. So that was, but at the start, no one knows. For start of lessor, people don't know they don't know their scale, they don't know their experience, so they want that security, because what if Avalon is unable to meet that debt? But as we got bigger, as we got much more, I suppose, established, we were able to get unsecured debt. So unsecured debt is essentially where we go to, again, another debt provider, and we say, give me this pot of money. But instead of being secured by the asset, the security or the recourse is to Avalon. So it essentially means that we don't have collateral on this debt, so therefore we're free to do with it what we want. It just provides a lot more security. And also, unsecured debt opens up a whole new pool of capital. This is essentially your, US dollar-based public debt market. So it's the capital markets, and they obviously have a lot wider kind of pool of capital instead of just going to banks. So basically, the takeaway from this slide that I want everyone to, I've said a lot here, but the main takeaways are that your ownership structure will dictate how you sort of what lens you view transactions through, and secure debt versus unsecured debt. So remember that as you get bigger, you want the percentage of your debt to be more on the unsecured side, so that you have more flexibility, and in theory, once you get to a certain scale, you can drive down your funding costs. So I've said a lot on that slide, but I want to make sure that that's clear, because there's actually a lot in there. It's very important stuff. And before I move on to the next one, I want to make sure, is there any questions? If there's something that didn't make sense, I can explain it in a different way. So if there, any questions on that before I move on? So I think it's, if I understand the question correctly, so as we got the ratings from Standard & Poor's and from the 3 rating agencies, the price at which we could issue our debt significantly went down. So, before we were rated high yield, and therefore if we went to the public market to raise money, we would have to pay a much higher interest cost. Once we got rated investment grade, our interest cost for that potential debt massively decreased. So therefore, the trade-off between going to a bank and asking them for a secured loan versus going to the public markets and getting a big pot of money, which was significantly cheaper, that trade-off becomes better. So yes, to answer your question, yes, once we got investment grade, the percentage of our debt that is unsecured has massively gone up. I hope that makes sense. Is that okay? Any other questions before I move on? Okay. Can you just move the slide? Perfect. So as I said before on the previous slide, these are the kind of different metrics, and I know I already discussed them, so I just thought it'd be good to kind of set the scene here and just explain them exactly. But the first one is IRR, so that's your internal rate of return, and the formal, I suppose, definition is the annual rate of growth that a particular investment is expected to generate. So this is assuming you have an outflow of a cash outflow at the start, and then a particular stream of cash inflows, and then maybe a residual value at the end. And another way to describe it is that it's essentially solving for the discount rate that makes the cash flows of a particular investment have a zero NPV, net present value. And as I said here, it takes the timing of cash flows into account, as well as the size, obviously. So therefore, private equity firms who have a very cash motivated business model, they use IRR based metrics to try and decide which investments should they seek or chase after. The other set of metrics are return on equity. So this is the profitability of a deal in relation to the equity that's involved in an investment. So if you had if Avalon was owned by public shareholders, that's the equity that they put in, and they want to see what is the return of their equity if they put that money into say Avalon versus putting the same amount of money in somewhere else. They want to see how much money am I making relative to the equity that I have in that particular business. And a lot of publicly listed firms, US dollar based or otherwise, will focus on ROE as metric. There's other metrics as well, but that would definitely be a one that it's easy to, it's relatively easy to calculate, and the idea here is you're trying to see, should I put my money with this company or should I put my money with this company? And how do you decide that? You decide that based on the ROE, say, of your investment, and therefore that company, when they're evaluating transactions, they need to see what is the return on the shareholder equity that by doing, say, a lease with this airline or a sale with this airline will provide. And then the yield over book value, this is the earnings that are generated and realized over a particular period of time. And very important to note here that it's an unlevered metric. So if it's a levered metric, it means that it has taken into account, or it already incorporates the funding aspect of that particular transaction. And this is a very helpful metric when you have a large portion of your financing costs which are unsecured, because if your financing is unsecured, it's sometimes very difficult to attribute the debt. So, as an example, if I go to the public markets tomorrow and I say I want to issue a bond, so that means I will say I want to say $1 billion, and the banks will go out and they'll ask lots of bond investors that how much money can you put in together, and they'll give me a pool of money and say that's $1 billion. Now I can use that $1 billion to go and do lots of different aircraft leasing and financing transactions. However, I don't necessarily have an exact portion of that debt that I can allocate. There's different ways to do it, but it's not necessarily accurate all the time. So that's why we use a yield-based metric, because it strips out that uncertainty of how much of that $1 billion is for this aircraft versus this aircraft versus this aircraft. Does that make sense? I think this slide is just kind of formalizing the three different concepts that are on the previous slide. But if there's any questions on that, happy to answer them now. Okay. Rob, do you want to just move on to the next slide? So in this one here, what I wanted to just kind of spell out was, again, I'm trying to really drive home the point which we made in the previous two slides, that ownership structure can dictate the transactions you do. And therefore, I've used very simplistic examples here, but let's take the first one as an example, right? So we have, some of the important parameters that we need to be able to price a lease. So the first thing is, excuse me, what is the price of the aircraft? So in general, there are three ways to acquire an aircraft, but let's think of it for a new aircraft. The first one being, I can go directly to a manufacturer, which is Airbus, Boeing, Embraer, etc., and I can say, I want to buy an aircraft from you. They will give me we will negotiate a price, they'll give me a price, and then once I have that aircraft agreed, I then have to go and market that aircraft to different airlines, and then say, I have this aircraft either now or will be delivered, and I want to rent it to you for either 10, 12, 15 years, whatever that is. So that's one way of acquiring an aircraft. The other route is the sale leaseback market, or the purchase and leaseback market, which is essentially I go to an airline who already have an order directly with the manufacturer. I'll say to them that, okay, you're buying the aircraft from the manufacturer. When you buy it, you instantly sell it to me, and I, as a leasing company, will lease it back to you. So that's my two sort of channels of acquisition, as it's known. So if we take an example where, now these are very hypothesized figures, so don't necessarily think of like the calculation of it. It's more the interpretation of what this means. So you could have in the first example here, the blue one, you have a price of $135 million. So that's the price that Avolon, as the buyer of the aircraft, will pay to Boeing. So this, as an example, is a Boeing 787-9 Dreamliner aircraft. I've just used a 2020 vintage. Let's say the rent that I know I can generate on this by going to a particular airline is $1 million per month. Now, in the current environment, that is extremely generous. Those rents have come down. But again, as an example, the LRF, so the LRF is known as the lease rate factor, and that is essentially just your monthly rent divided by your price. So it's $1 million divided by 135. And why is that important? It's because sometimes it's a way to normalize the rent that you are getting relative to the price, because if you might be getting so in the second example there, you can see we're getting a rent of 0.96, so 960,000, which is less than 1 million, but the price is also less. So sometimes knowing does the LRF, you essentially, the higher the LRF, the better return you're getting. You need to know how long the lease term is for. So, if you think of it, the cash flows here, the price is 135 million, that's what you pay out. Then the rent is what you're going to get in every month for that lease. Then the term determines how many months of rent you're getting. And then at the end of those 12 years, you have what's called a residual value. So what is left of that aircraft? And the residual value is calculated with respect to what's known as the redelivery condition. So these are, now this is quite a detailed topic, so I won't go into it, but just to explain in general, you have essentially what's known as a full life redelivery condition or half-life redelivery condition. And this, when we say a full life redelivery condition, so in this example here, what that means is after the 12 years, so the aircraft that we lease to the airline, they have an obligation to do what's called maintenance work, and that's generally something that's negotiated in the lease. But regardless of how that's negotiated and what their obligations are, by us saying that the redelivery condition here is full life, it means at the end of the lease, from a technical and maintenance perspective, the life of the aircraft, it's as if it has just come out of the factory and it's essentially been restored to full life. So all the components, all the different the various maintenance checks on the aircraft have all been completed, and they have brought the aircraft back to full life. And that's important because if you think about it, we're trying to calculate, in, for example, the IRR, we're trying to calculate at the very end of my 12-year lease, what is left of that asset. So what is the value of that asset? And the value of that asset is determined by the redelivery condition. Because, if you think about it, if the converse, where the aircraft was half-life, that means that the engines, the other kind of big components, they don't have the full life left in them, and therefore, if you want to bring it to full life, to be able to put it into a serviceable condition, you need to put it through a maintenance program where all these checks need to be done. That costs money, that takes time. So if you have one lease where the airline's obligation to you is to return it in that full life, it has a higher residual value versus one where it doesn't. And if it has a higher residual value, that means your internal rate of return will be higher, your other metrics will be higher as well. So if we take this first example here, when you put in those parameters and you do the calculation, it's telling me my IRR, my internal rate of return, is 13.7%. My ROE is 12.5%, and the yield is 8.5%. And then likewise, not the same, but on the right-hand side, slightly different set of parameters where you have a price slightly lower, you have a rent slightly lower, and then you have same lease term and same redelivery condition. So why am I showing this? The point here is that if you were a leasing company where your ownership structure was, for example, a private equity firm, which has a much higher focus on cash coming out of the kind of cash coming out of an investment earlier, you would do, if you had to choose between these two, you will do the second one because it has a higher IRR, right? Even though it has a lower ROE and a lower yield, you'd still prefer the one that has the marginally higher IRR. Why? Because that is your investment thesis. You want to put your money in and get it out as quick as possible, and the one that will do that for you is the second one. However, if you were either a publicly owned company or privately owned, where your investment thesis is that it's not necessarily cash focused, it's more ROE focused, you would do the first lease instead of the second one, because for you that makes more sense than the other one. So I'll stop there for a second because I know there's a lot of numbers on screen here, and I've probably given a few concepts that are difficult, but I think the key takeaway here, again, which is probably from the previous ones as well, is that you could have two set of transactions which, one leasing company might decide to do one over the other, whereas another leasing company in the exact same environment might decide to do the other one because that's their that's their MO, that's their motivation. They need to do that one because that makes sense from their business plan, from their perspective, from their debt stack. Now, obviously, when things come down to it, especially if it's in a very COVID has made the I suppose the industry it has a lot of the rents have tightened, the values have tightened, so that kind of difference is not as pronounced as it was before. But ultimately, the principles still hold, and this is we're in a recovery phase, and there's little there's volatility, so you see changes, but you have to look at this over a long time frame where the industry has been around for 20-30 years and will continue to be around for a long time. And if anything, COVID has shown us that the proportion of aircraft fleets that are leased in globally has increased dramatically because leasing has shown to be a resilient business model. It is very well diversified from a risk perspective, from a capital raising perspective, and it's a lot stable and safer than airlines because most leasing companies are able to redeploy their assets a lot quicker than airlines can. So don't just look at this in the context of the last 2 years, look at this in the context of the next 5, 10, 15, 20 years. Any questions on that before I move on? Because I think there's a lot of topics there, and I want to make sure that people feel comfortable. Again, don't be confused by the numbers. It's the principles that I want everyone to focus on. Okay, Rob, do you want to just slide up a little bit? So the other thing I wanted to maybe that I wanted to kind of show here, again, I'm focusing on Avalon as the kind of my test case here, obviously because I'm familiar with it, but again, you can apply this to anything. That the first thing that originally we've been discussing with, as you start, your ownership structure dictates how you kind of price transactions. So that's obviously true, and it's happening. The other kind of effect that is happening in parallel is what type of a lessor are you? So when lessors start up, typically they don't necessarily have a big order book. They don't have a big portfolio of assets. So when you start up, you're in like growth mode. You want to try and do deals, and you want to try and grow your fleet. And again, the three, I suppose, ways to do that. One is you do sell lease back, and that's generally easier at the start as a lessor because you go to an airline and the airline already has an order from different OEMs, and they're willing to sell it to you. Obviously, they make a profit on that, and it gets leasing companies a way to kind of acquire those assets. The other way to do that is actually just go directly to other leasing companies and buy an aircraft with a lease already attached. So you already have contracted cash flows already attached. And that is another way to sort of inorganically grow your business. Then as, for Avalon, as we got bigger, once we started doing lots and lots of sale-leasebacks, we have acquired a lot of aircraft, and we're able to do that because it's a very relationship-heavy driven business. Well, another big part of what we do is we trade aircraft, which is that we sell. So once you generate a lease from a sale-leaseback, we will sell it then to other leasing companies like ours for a profit. And what you're essentially doing there is you're monetizing the cash flows that we have built into the lease now. So when you sell it now, you're essentially monetizing whatever future cash flows you have based on today's expectation of that. And trading for us and for other leasing companies, it's a very effective tool to recycle our equity, to recycle our capital, and use that to then redeploy into, hopefully in transactions that will yield a better return for us. And then as you get older in your maturity cycle, you gain a certain amount of scale. So then for us, that was around the 2016, 2017 mark, where you're able to make direct orders with the OEM. So that's the equivalent of Avalon going to Boeing or Airbus and saying, give me 50 aircraft, give me 70 aircraft over the next, 2, 3, 5, 10 years. And once you do that, you can really drive economies of scale for the pricing. So the price that we need to pay to the OEMs, that's one of the biggest factors that determine how profitable a deal is going to be. So you can only really generate significant value there if you order in scale. So we are now, we're the third largest lessor, and we will be able to generate significant discounts with Airbus and Boeing because of our size, and not just with Airbus and Boeing, also with the engine manufacturers. So, we can go to CFM, we can go to Pratt & Whitney and say, we want 200 engines over the next 5-10 years. That gives us credibility and scale, and therefore it gives us a pricing kind of advantage and comparative that other, say, smaller leasing companies wouldn't have. And then the other thing that as you kind of get into your, once you get into a more mature stage of your corporate life cycle, is the leases that you would have done originally, they're now coming up to their maturity. So, leases we generally want new aircraft leases to be anywhere between 8 and 12 years. And then as those leases are coming off their, once they're becoming mature, we will need to take those assets back and then remarket and transition them into other operators. And there's a whole host of maintenance and remarketing activity that comes with that, which is can be very time costly, but also cost from an actual dollars. You have to reconfigure the aircraft, you have to do checks, you have to find a new home for that. So as you get the type of lessor you are will determine what sort of remarketing activity you need to engage in. Any questions on that before I move on? Okay, Rob, do you want to slide up? So this is just a quick overview of what I discussed on the top page, but again, very important to take this away, that what exactly do you need to be able to price a lease? So you will need to know the aircraft type, because the aircraft type will determine what is the residual value, you also look at what are industry known appraisers, which we will talk about in a while. So what is the value of that aircraft as viewed by the different appraisers? What is the price that you're paying? What is the rental yield that you're getting for that? What is the lease term? What is the redelivery condition? So, it's a very simple discounted cash flow model if you think about it. That's all you really need. These are like, you can go into more nuances and more specifics, but if you just sort of step back a little bit, these are the 5 kind of major parameters that you need to be able to give you the IRR, to give you the ROE, and to give you the yield-based metrics. So for you, after this kind of lecture, this slide, if someone was to say to you, oh, I need to price a lease transaction, the things that you need to do to be able to kind of get through the steps of doing that, it's a simple discounted cash flow model, but you need to know what is the price you're paying, what is the rental you're getting, how long you're getting that rental for, and then at the end of that lease, what is the redelivery condition? So what is that aircraft going to look like at the end of that lease? And that's all determined. It's very prescriptive. It's done very much at a component, at every single component level, and it will be in the lease. So there's no way to sort of deviate from that. It's something you negotiate, and once it's written in the contract, there's no room for interpretation there. Any questions on that before I move to the next slide? Okay, keep going, Rob. Yeah, so I put this slide in, and I was almost contemplating taking it out because I'm not directly in that team, but actually I thought it's still very much relevant because what I'm trying to capture here is any team in any leasing company that looks at the evaluation of kind of transactions. Now, and more or less, it'll be spread out like so. This is work streams, if you want to call it, or subcomponents in that team. And this is the type of work that they cover, because I think it's important if people are doing this course and they're looking at going into, say, different leasing company works. An example in Avalon, and indeed other leasing companies, you have what are called the pricing teams, or they're called in ours we're called the transaction structuring team. I know in Goshawk, I think, or in Oryx maybe, I think it's called commercial analysis. So it's just different names for effectively the same type of like workflow. And generally the work is split by, so the placement and sale leaseback. So this is aircraft, new aircraft that we already have on order. Or through the sale leaseback channel, so looking at transactions related to that. Remarketing, effort, that we're looking with